Hello, everyone, and welcome to MSUFCU's Financial Education Seminar Series. We appreciate you all joining us and are excited to be here with you virtually. These presentations were created with you in mind, with the intention to give financial education on a number of relatable topics to help expand your knowledge of finances. Each event will be hosted by a member of our financial education department or by one of our partners, connecting you with resources in your community. We have a number of diverse presentations planned for you this year, and you can explore and register for them by visiting us at msufcu.org/events. Today's event is being recorded. To rewatch or share the presentation, go to youtube.com/MSUFCU, then select MSUFCU Seminar Series from the playlist options. Recordings are available within 2 weeks of the events. We will have time after the presentation to address questions submitted to the Q&A, and this segment will not be recorded. You may send your inquiries at any time during the event, which will later be answered in the order they were received. We will also provide additional information and resources in the chat, but please reserve the Q&A panel for your questions. I'm Therese Bacon. I'll be your facilitator this afternoon. If you have any concerns or technology issues, I invite you to reach out to me in the chat. Again, questions for our presenters should be submitted to the Q&A. Today, we have an amazing guest joining us to present on preparing for home ownership. Allow me to introduce our host, Catherine Wall, who works as a Partner Experience Manager for GreenPath Financial Wellness. GreenPath is a proud partner of the credit union and has been in business for over 60 years. They're a national and accredited nonprofit organization with an A+ rating with the Better Business Bureau, who aims to help their clients achieve financial wellness and stability. Welcome, Catherine, and thank you so much for joining us. Why don't you go ahead and introduce yourself to our audience, tell us a little bit about your position with GreenPath, and then we can lead right into your presentation this evening.
Thank you, Therese. I really appreciate that. So as Therese mentioned, my name is Catherine Wall. I'm a Partner Experience Manager with GreenPath Financial Wellness. I basically work with a lot of our credit union partners, and it's my job to help them. I get value from this program, and the value is in providing financial education and counseling to their members. So today's presentation is all about preparing for home ownership. And I wanted to start out by just applauding you for attending and for watching this webinar. We truly don't know what we don't know. And I just want to give you an example of this. That when I first came to the US, I'd already bought and sold with my husband a couple of houses in the UK. But I didn't know how the process here worked in the US. In the UK, we do not have buyers and sellers agents. We only have an estate agent who is responsible for selling a particular home. There's not multiple agents. So when I first arrived, I basically went to the sign in the yard and called that number. So anybody who is listening to the webinar now knows that that is the telephone number of the seller's agent. That is not somebody who is working in your best interest if you're hoping to buy that property. So again, I applaud you for attending. We don't know what we don't know, and I'm hoping that you find today's webinar, this recording, to be a great start on your journey to purchasing that home and enjoying owning your own home. So let me kind of go through our quick agenda for today. We're going to spend the first half of the webinar talking about preparing and learning about the home buying process. So that's going to include preparing to purchase, financing the home, and finding the home. The second part, we're going to focus on being a responsible homeowner. And we want to think about preparing for an emergency. Once you've purchased that home, we want to make sure that you're able to maintain it and you're able to stay in it regardless of life events that may come your way. So with that said, let's start with preparing to purchase. Before making a large purchase like a home, it is essential that you prepare financially. You want to make sure that you're buying something that will be affordable. So the very first step in preparing to buy a home is reviewing your budget. Now, instead of creating a budget based on what you think you should be spending, I highly recommend pulling your bank statements and your credit card statements to determine what are you actually spending, especially when it comes to items like groceries, gas, and discretionary items such as clothing and entertainment. You'll also need to pull your pay stub so you can create the budget based on what you receive in pay after taxes, insurance, and other deductions. So to make this process easier for you, we like to share a budgeting worksheet. So you can just take a photo of this QR code on the slide, or you can click on the link that Therese is providing in the chat. This is a great budgeting worksheet, and I think you'll find it very helpful in terms of helping prompt your thoughts in terms of where are your dollars going. So having gone through that process, and now you know what you're spending and what you receive, you're going to be able to create a budget and make any changes you think are necessary to reach the goal of buying your home. So for example, if you find that you're spending $300 a month on dining out, maybe you decide to cut that back to $100 a month because you want to use that extra $200 to build savings towards your down payment or closing costs. Now, it's great to create the budget, but the next important step is to track your spending to make sure you're sticking to the spending plan. Now, if this process takes a few months to get used to, that's fine. Most people are paid bi-weekly. If you've never budgeted before, maybe you'll find it easier to track your spending on a bi-weekly basis. Do not give up on budgeting and tracking your spending. Habits can take a little while to form, and budgeting, if it's a new habit, you'll just have to get used to that. Now, the one thing I also want to mention is don't think that just because you spend a little more this week than you wanted to, that the whole month is a wash. Look to make some savings during the following week and get back on track. You want to be patient with yourself, give yourself some grace. And if you have a family, you want to include them in the process so everyone is on the same page and working towards the goal of buying the home. Now, although each budget is unique, there is a rough guideline of the average budget. Now, as you can see, housing is generally up to 35% of your overall budget. Now, this includes your mortgage payment, which is principal, interest, taxes, insurance, any homeowner association fees or HOA fees, as I'll reference them as we go through the presentation, utilities and maintenance. Now, if your budget exceeds 35%, you'll need to decrease expenses in another category. So, for example, if you have no other debt, you can allocate some of that income towards your housing. And obviously on our budget here, we're allocating 15% towards debt. Maybe you don't have any, and therefore you can use those dollars. Or maybe you can decrease expenses, maybe in terms of entertainment or transportation. You may live in the city. Your transportation costs may be fairly low. Housing may be a little more expensive. And so you can see this is a general guideline. The goal here is you need to personalize this in terms of what is going to make sense for where you're living and for your particular budget. So next, let's focus on savings. The down payment is usually what most people think of as the savings required to purchase a home. Right now, down payments can be as low as 3 to 3.5%. You no longer have to bring that full 20% to closing as a deposit. Now, while a lower down payment can mean a higher monthly payment, and this also may include private mortgage insurance, PMI, as I'll reference it as we go forward, because you have to borrow more to set for the same home, obviously putting less down, higher payment, the difference between the payments, it may be smaller than you think because typically mortgages are over 30 years. So don't be afraid to contact a lender if you think you'll be putting less than 10% down on a home. There are loan products to help you meet your goal of buying a home. And you know, a 20% down payment on a $200,000 home, that's $40,000. That's a lot of money to save. But with a 3.5% down payment, that's just $7,000, which of course is going to be a much easier amount to save for a first-time home buyer. Now, another point, you can actually use gifts to cover the down payment too. So maybe if you have a parent or a family member who's open to helping you purchase your first home, you know, this could be a good resource. Now, what you need to know in this case, though, is if you are going to use a gift to buy the home or for that deposit, your lender may have the gifter sign a gift letter saying that the family member doesn't expect that money back. It truly is a gift. And even if you are using a gift, it's still a good idea to be saving money on a regular basis, because as you're going to see further in the presentation, these savings are going to be important for home ownership. Now let's talk about closing costs. closing costs are usually around 2 to 5% of the loan amount. So once you've saved for the deposit, you'll want to keep saving to cover these expenses. Closing costs can include a loan origination fee, an appraisal fee, title fees, escrow fees for taxes and insurance, an inspection, and if appropriate, PMI, the lender's mortgage insurance. This is among other things. Sometimes as you go through the home buying process, you may have the opportunity to negotiate for the seller to cover a portion of these closing costs, especially if there are repairs that need to be done to the home. However, I don't recommend you going into a home purchase assuming that this will happen. You want to make sure you have everything set aside for these costs up front. Now, generally, we recommend trying to have about 3 months of living expenses in an emergency fund, just in case there's a loss of income and it takes time to get back to work. During the home buying process, a lot of people turn to their emergency savings to cover the cost of the down payment and sometimes the closing costs. And, it's fine to use some of those savings, but you've got to be sure to have money left over for an emergency repair or an unexpected expense, and you have to have a plan to replenish these savings ASAP. Lastly, moving costs and appliances. It's not uncommon to have to hire a moving van to move your belongings to your new home. A moving van may be only $100 for the day or so, but it's still $100 that you need to have on hand so you're ready to move after closing. Another point, from my years of being a housing counselor, the most common appliances I see not come with the home purchase are a washer and dryer. If you know you're buying a new home and it may not have an appliance you're used to having, you'll want to have a budget, you'll want to budget rather a sufficient amount for after closing to be able to replace that appliance, or be prepared to go to the local laundromat. And maybe that's a temporary solution. We also have to think about home updates. This is obviously, once you've moved into the home. If you don't have anything left over to cover your wants when you first get into the home, you may find yourself very tempted by credit cards and the furniture store loans to furnish the home. But if you don't have wiggle room in your budget, you're going to likely struggle to cover that new monthly payment for that loan. And that can be a recipe for disaster when you're first starting out as a homeowner. However, having sufficient savings for each of these categories really can set you up for success. So, you have a deposit to purchase your home and you've set aside the closing costs. The next step will be to finance the remainder of the purchase price. And this is going to be why credit is important. So the first step is to review your credit report. Now, there are 3 major credit bureaus that collect your information and generate credit reports. And those are, as the slide says, TransUnion, Experian, and Equifax. When it comes to applying for credit, different financial institutions may review different credit bureau reports. In some cases, when applying for a mortgage, the lender may review all 3 credit bureau reports. And so this is going to be why it's important to be on top of what is reporting to those 3 credit reports for yourself and if you have a financial partner. It's recommended that you review your credit reports for all of these 3 bureaus once a year, home ownership or otherwise. So this is something that you want to maintain as a habit going forward. Now, different information may be reported to different credit bureaus. In many cases, the information will vary, as some creditors may only report to one bureau because it costs to send information to these 3 credit reporting bureaus. So you'll want to make sure that all of those 3 bureau reports are up to date, and you might also want to be sensitive to the timing on when things post. Now, the recommended place to get your credit report is annualcreditreport.com. It's the website that was set up as a result of the Fair Credit Reporting Act. And this is the act that states that you are entitled to receive a free copy of your credit report from each of the 3 bureaus once a year. Now, just a side note, as of the recording date, we're in February of 2024. Currently, the 3 national credit reporting agencies, Equifax, Experian, and TransUnion, have permanently extended a program that lets you check your credit report from each of these agencies once a week for free. Now, that's just the report, not the score. You would have to pay extra for the score. Now, when you go to annualcreditreport.com, you should see this logo that you'll see on the slide here. So be sure you see this logo. I would say it's best to actually type in the full and exact website into your internet browser, because there are a lot of imposter sites. If you're being asked for a credit card, you know you're in the wrong place. So just be very conscious of this. I highly recommend doing the credit report pull on your desktop computer or a laptop so that you can save that report and get back to it easily and use it as reference. If you prefer, there is also a form that you can use to request your credit report by mail. You can either call the number on the screen, or you can actually go online and request that to be mailed to you too. So now that you've got the report, you need to review it, and especially review for any negative or derogatory items, because these are going to impact your score, and that's going to impact the cost of financing your new home. So just a note here, GreenPath is a housing and urban development, or a HUD certified housing counseling agency. So we can help you with understanding your credit, and we can provide you with the education to help you prepare for your home purchase. So we'll reference this again at the end of the presentation, but I just want to mention this just so you know you're going to have help here in this process. Now, the great thing about credit is if you have had some issues in the past, it's not going to be there forever. There are ways to work towards improving it. Now, open collection accounts can have a negative impact on the credit score, as I've mentioned. So if you see that you have any open collection accounts that you know are valid, now would be the time to start making payment arrangements so that collection bill doesn't prevent you rather from moving forward with the home purchase when you found that home that you love. You don't want to end up with an obstacle here. So also, credit card balances that cannot be paid off in a month or two can also impact your credit score and your debt to income ratio. Now, we're going to talk more about that ratio later, but here's the key. If you have the ability to start making higher payments on these cards to get those balances down, I highly recommend you do so. And don't forget your student loans. Your financial institution will take a certain percentage of your student loan balance to calculate a payment for your debt to income ratio. So even if you're currently in a forbearance or deferment and are not making a payment, don't forget that these student loan payments exist. You will need to make those payments at some point, so they need to be included in the finances. So if you do find inaccurate information on your credit report, note that you have the right to file a dispute. This is important. First, you'll want to dispute the item with the creditor or the collection agency directly that reported that information to the credit bureaus. Now, if that doesn't resolve the issue, you can file a dispute with the credit bureau itself that is reporting the inaccurate information. Now, you should include any documents to support your dispute and allow 30 to 45 days for the credit bureau to complete the investigation. Now, just a side note here, be sure to keep copies of any documents you submit for your own records. But as you can see with this timeline, this is why it's important to get this started early in the home buying process, because it can take time to handle any particular credit issues that need to be disputed. Now, if you're still unsatisfied with the outcome of the dispute, so you have filed a dispute with the credit reporting agency, and they come back and say, no, the complaint is, the dispute or that particular trade line, as we say, in the trade about the credit report, they're saying that's accurate, the creditors provided information, we believe this to be valid, you do have another level of recourse. You can actually file a complaint with the Consumer Financial Protection Bureau. And we're going to chat that contact information into the chat. And if obviously you're watching a recording, no, you can just go online and go to www.consumerfinance.gov/complaint. So we've talked about the spending plan. We've talked about getting our credit ducks in a row. Let's now talk about financing the new home. We recommend that you get a pre-approval letter from a lender before reaching out to a real estate agent. And the reason for this is, you know, if you find a home you love, you want to be sure you are ready to make an offer as quickly as possible on the home. And this letter is also going to help the real estate agent that you choose, and we'll talk a little bit about that soon, that they're only going to be providing homes that they know are in your price range. It can be disastrous to go to a home that is not truly affordable, fall in love with it, and just think you can make this work, because truly you want your home ownership journey to be one of pleasure. You don't need the stress of struggling with finances by purchasing something that really isn't affordable within your spending plan. So obviously, in order to get that pre-approval letter, you're going to have to find a lender to write it. So if you have a relationship with a current financial institution, so if you are a member of MSUFCU, they can be a great place to start. It can actually make the process easier as well if you're with your current financial institution, because they may already have all the information that's going to be needed, such as bank statements, right at their fingertips. If you don't currently have a lender, maybe you have a family or a friend who can a family member or a friend who maybe they recently bought a home and they worked with somebody that they really liked. Ask for the referral. So obviously, I've mentioned the pre-approval. Let's take a deeper dive into what that actually is. So let's start by giving a definition. What is a pre-approval letter? Well, it's a formal commitment from the lender that they are going to give you a loan up to a set loan amount that will be listed in the letter. That offer is going to stand for a designated amount of time, usually 60 to 90 days. This is also going to be recorded on the letter. Now, in order for this, there may be a fee for pre-approval process, not always, but occasionally. And also just note that you must still meet the qualification requirements at the time of your purchase. So when you get this pre-approval, it's important to note, do not go out and get more debt. Do not go out and co-sign on a car for somebody, because that is going to invalidate that pre-approval. You have to be able to qualify when you come to closing. So again, for the pre-approval, the lender that you're working with, they're going to commit in order to loan a certain amount of money, but they're going to be doing this based on your income, expenses, and credit. So to prove your income, you're probably going to have to provide pay stubs. If you're self-employed, be prepared. They may want your tax returns. As of this recording, I just want to let you know that MSUFCU's pre-approval process can take approximately 1 to 3 business days. Now, they may also ask you for proof of assets. So if you intend dipping into maybe like a savings account or retirement account to cover the down payment, they may request bank statements to actually as proof of funds. So they can show that you have that cash on hand to cover the closing costs and down payment. Your lender's most likely going to do a pull of your credit report to get a list of your debt repayments. And this is going to include things like car loans or large balance credit cards. In certain circumstances, you may be required to provide a few other documents. We already mentioned the gift letter for the down payment, but the lender may also ask for a letter explaining credit issues or divorce papers and child support papers. Again, if you are relying on a gift from a friend or a family member to help cover that down payment or cash to close, they may have that person sign a gift letter stating that this is not a loan and they will not be asking for that money back for you. So that is really important when we're thinking about the gifting. Now, early in the webinar, I mentioned debt to income ratio, and now is a good time to go back to this topic. In the home buying process, you'll probably hear people talk about two qualifying ratios or debt to income ratios, DTI. These ratios are used by the underwriters to determine if the potential mortgage amount will be affordable for you. The financial institution wants to set you up for success. Now, if your current ratios are higher than the allowable maximums for the lender, you're going to need to either increase your income, decrease your debt load, or purchase a less expensive home. So the sooner you know this information, the better. And again, this is all going to come through in your pre-approval letter. Now, a front-end ratio is going to be the comparison of your gross monthly income against your mortgage payment. So this is going to include the property taxes, the insurance, and even the HOA fees. So that mortgage, we call it PITI and HOA. Now, the ratios can vary depending on the lender and the type of mortgage you're applying for. Typically, a front-end ratio can be anywhere between 28 and 31% of your gross monthly income. Now, the back-end ratio takes all of your debt payments, including your future mortgage payment, and compares it to your income. So this is calculated by dividing all your monthly debt obligations. So this is the potential mortgage payment, the PITI, and credit card debt, student loans, auto loans, and everything such as that. And this is divided by your gross monthly income. Typically, a back-end ratio is 36%, but some lenders and loan types will go higher. As of this recording, MSUFCU may approve up to 43% DTI and on occasions may go all the way to 50%. But again, this is not to be banked on. This is very much dependent on the individual situation and finances. Now, something I want to point out, you have to keep in mind that these ratios are just one of the things that the bank will use to determine what they will lend to you. It's important, though, that you recognize that they don't take everything into account. Just because you can qualify for a given amount based on the ratios doesn't mean that that amount is affordable. You will want to make sure that you review your budget to determine what you can afford. If you pay childcare, private tuition, or other large expenses that aren't included in that debt, you have to have these in your spending plan. So again, these ratios are important in order to qualify, but you need to do some extra work to make sure that you're actually applying for an amount that is affordable for you. So let's talk a little bit about the different types of mortgages. And again, this is not comprehensive, but I want you to be able to recognize some of these terms because you will hear them. So first off, let's talk about a conventional loan. This is a mortgage that is not insured or guaranteed by the government. Instead, it's going to be held by a commercial lender or private investor. FHA, USDA, VA are all government-backed loans. So this means that the federal government insures the loan, protecting the lender in the event that a borrower can't repay the loan. And the federal government implements specific guidelines for the mortgage companies for these particular types of loans. For example, an FHA loan may allow the borrower a lower down payment, like 3.5%, but may require a home inspection that cannot be waived. USDA and VA may have loan products that could require a 0% down payment. And a lender who works with those types of loans is going to have to guide you through the requirements that you need to go through to qualify, because there will be a series of things you'll need to do. Now, as I'm sure we're all aware, interest rates have gone up a bit since the historic lows we saw during COVID, and it can make home buyers question whether or not they should even wait to buy a home. Obviously, payments will be higher based on those higher interest rates. However, don't forget that when interest rates go up, generally people are a little more conservative and maybe there are fewer buyers, so housing inventory goes up as well. Now, more inventory, and what do I mean by that? Well, more homes on the market to be sold. If there are more houses, more inventory, you may be able to start making lower offers. And this may help you negotiate for things like seller concessions, and that could lower the amount of cash you have to bring to closing. And also, while higher interest rates may mean higher payments right now, in terms of getting into the home, if you keep your credit up, you may be allowed to refinance to a lower rate and a lower payment at some point in the future. So all things to consider. So we've talked again about the budgeting, we've talked about credit, we've talked about, financing your home. Now to the fun part, finding the home. This is where it gets really exciting. So obviously, you initially start by finding a realtor. You need somebody, again, remember when I first started this webinar, I talked about calling the phone number on the sign in the yard of the home I was interested in buying. That's the seller's agent. You need a buyer's agent. You need to find a realtor who's going to work for you. So you can start by maybe speaking with friends and family to get a referral. Find somebody who knows somebody who had a great experience. That can be a good opportunity, but you will want to interview that person. Check out a few realtors to find the one that you're really comfortable with. So that's the first step, getting the realtor. Now, I will also say you can search online for a real estate agent in your area. When going to a completely new area, sometimes people focus on looking for someone who has experience in that area, looking for homes. Maybe it's a new city. Maybe they go online to find somebody who's sold a lot of houses in a particular zip code that they're interested in, because obviously that person is going to be knowledgeable about the types and styles of homes that are going to be available in that area. Obviously, you want to figure out where you want to live. This is the next part we talked about. Is it going to be are you moving to a particular city for work, or is this you're just looking to buy a home in the area where you currently live in? Knowing where you want to live is really important. So things to consider when you're thinking about where is, is there a certain size of home that's going to work well for you and fit your family's needs? If you're planning on having children or already have children, do you have a certain number of bedrooms and bathrooms that are going to be required? Do you have a certain school district that you're trying to stay within? Again, this is where the realtor can really help you. Some people love homeowner associations. Some people do not. Some people do not want to have an HOA fee. That's going to impact the neighborhoods that might be available. Again, you need to kind of have a decision about what are you going to look for. A couple of other important things to consider when looking for your new home. Do you want a ready-to-move-in home? Maybe you have young children and you're busy with children and things of that nature, so you cannot be dealing with home maintenance. Or are you open to getting a home that you can add sweat equity to? You'd rather get a deal and do the extra work. Obviously, you need the skills and the tools to do that. That's going to be a key component here. But what funds do you have also, to do those repairs and maintain the home, if that's what you're looking at? And really important aspect as well as the commute. Ideally, I would highly encourage you to drive the route during the normal commute from an area that you're interested in buying in. You want to make sure that that is a manageable commute. Also consider going online to check for road repairs. Is it likely in the next 12 months that there's a plan to repair the highway between you and your job, and it's going to extend that commute? It doesn't hurt to be prepared. Once you've found the home of your dreams, your real estate agent and the mortgage company that you're going to be working with are going together to guide you through the rest of the purchase process. Now, your real estate agent is going to be responsible for writing the offer letter that they think is competitive. If the seller chooses to move forward with your offer, you are on your way. And this is a legal document. You will actually submit your earnest deposit. This is kind of a good faith deposit, not the full down payment, but you'll submit a good faith deposit along with that offer to the seller. Your agent will do this. And then if the homeowner agrees to that particular offer and they agree to sell the home, they're going to sign that document. And this becomes a legally binding document, but you can have some what we call clauses in there, just in case there are problems. So for one instance, you're going to want to do a home inspection. Part of the offer may have a clause in there that you withdraw the right to, to pull out of the purchase if there are certain issues with the home. And you're only going to find those in the home inspection. So this is really important to do. Typically you'll have about 7 days to get the home inspection done, and just make sure the home is in good condition. Now, this isn't typically required, although I mentioned obviously sometimes it's a government-backed loan. They may require a home inspection. Conventional mortgages don't typically require a home inspection, but I highly recommend you can use this inspection as your kind of maintenance plan for the next 5, 10, 15 years, and that's a great tool to have. You'll also be expected to get an appraisal. This is really for the lender. They're going to want to make sure that the home you're buying is actually worth the money you're offering. If the offer comes in less, you may have the opportunity to negotiate for a lower price with the seller. Or you may have to sign a document that says, yep, I know I'm paying a little extra, and the lender may ask you to put down more money. And this can happen. So the other thing you'll need to do is get homeowners insurance for the home. Your lender will want to go over when they need to have your lender's going to go over with you when they need to have each of these steps completed. And it is important to get them done in a timely manner because you want this process to be completed and go through to a smooth closing. So now that we've gone over the preparing to buy the house, let's just take a moment. We've gone through to the close. We've closed. You now own this home. We want to make sure that home ownership is as stress-free as it can be. And so what we want to talk in the next section is, how do we prepare to be a homeowner? We want to think about how can we be prepared for any kind of eventuality. Home buying, it truly is one of the most exciting times of your life, but for most, it's probably the biggest single investment that they will ever make. And so it's time to think about, having bought the home, what happens if we do hit a bump in the home ownership road? They're going to be inevitable. You're going to be buying this home for 30 years. Typically, that's the length of a mortgage. So we can expect some little bumps on the way. We just want to make sure that you're prepared for them. So the first thing I want to talk about is savings, and truly automating savings. Having savings, an emergency fund, really can be a huge start on making sure that you have a great homeownership experience. The pandemic has shown us how essential it is to start building the savings plan as soon as possible, because if you have a loss of income, that mortgage payment is still going to need to be paid. The taxes, the insurance still need to be paid. So automating the savings process can make it so much easier, because the money's transferred out of your account into that savings account before it can be spent on other expenses. Now, the goal is really to put 10% of your income into savings every month. Do you remember we did that homeowner budget early on? 10% was for savings. Now, that may not be practical early on. However, something is always better than nothing. So if you can't do 10%, go to the budget and determine what you can do and start there. The goal is to have 3 months of living expenses. This will set you up to handle an emergency. You want to make sure you can access the funds quickly. So don't rely on anything such like 401k funds, which can take time to be sent out to you. And there are lots of implications of 401k funds, taxes and penalties and things of that nature. So again, let's work towards that goal of 3 months of living expenses. Now, do keep in mind, for some people, they may be fine with less than 3 months worth of living expenses. If they have a financial partner who can take up more of the financial responsibility, if one partner is out of work, then maybe a smaller savings can work. Or maybe you work in a field where you can quickly find a job if you get let go. Maybe you can be okay with less money in savings. But again, think about the pandemic. Better be prepared. So assess your own situation, but have a longer term goal to have these 3 months worth of savings set aside. Now, in addition to setting aside an amount each payday, consider using any kind of raise that you get, tax refunds, and bonuses to boost the savings, because that money's not already part of your budget, and it can be easier to move that aside into savings. And it really can accelerate building that 3-month emergency fund faster. Reducing your other debt is also a key to being ready for an unexpected event. Obviously, reducing your liabilities is going to make it easier to get through any particular financial challenges. So you may have heard of the debt snowball method to pay off credit card debt faster. In this situation, you start with either the lowest balance, that's the snowball, or the highest interest rate balance, which is the avalanche. What you're going to do is you're going to add a little extra to that minimum payment every month to pay down the balance. Now, you're going to be making the minimum payment on all the other accounts. You're just adding any extra to that lowest balance or highest interest rate card. Once that is paid down, that payment is going to move to the second lowest balance or the second highest interest rate. And you're going to keep following that process until all of the balances have been paid off. Now, obviously, this is only going to work if you have some extra money that you can put towards the debt, and also you don't continue to spend on the cards. So that's really important here. Now, I would say to keep your balances from growing too large in the first place, avoid charging non-essentials. So this would be things like eating out, clothing, or other impulse purchases. I know I'm going to be traveling to England soon, and I'm going to be using points to get some free flights. That can be great, but if you want to use or spend or put these expenses onto a credit card to get points, make sure it's a card that is set up to have the balance repaid in full every month from your checking account. That will keep you disciplined and make sure that you don't start building a balance. You want to be sure, if you feel that starting to use credit cards might be a bad plan for you because you find it too easy and maybe you don't always have the ability to pay those off, instead set the budget for these items and use cash. Just only use the credit cards for true emergencies like a car repair or a medical issue. You want to plan ahead in your budget for things like holidays, vacations, so you don't have to use the credit cards. Birthdays and anniversaries occur the same date every year, so we can plan for those. We can set aside money each month in preparation. You can also consider low-cost activities like going out for a picnic if it's in the summer, or visiting a museum. Find a fun activity instead of buying an expensive gift or going out for an expensive dinner. It's all about finding strategies that work for you. You can also explore a consolidation loan. If you've got several credit cards and they've got high interest rates, maybe a consolidation loan is a good way to give you one lower monthly payment with a lower interest rate, so you get those debts paid down quicker. Again, though, this only works if you stop using the credit cards and you don't begin accumulating a balance again. So if you're thinking about consolidation loan, go to the MSUFCU website. They do have a web page there where you can kind of take a look at consolidation loans. Now, excuse me. If you are really struggling, if you have a lot of debt and once you get the home, maybe you've overspent, one of the things you can consider is maybe it's time to think about a debt management plan. And that's something that's only offered through a certified nonprofit credit counseling agency such as GreenPath. This plan helps you consolidate your payments into one amount with lower interest rates. Now, the debt management plan, this isn't something to kind of consider lightly, because accounts are going to get closed and can be a negative impact to credit. But again, if we're looking to get prepared for an emergency and we know we're not going to be relying on credit going forward, maybe this is an option. But I would encourage you, talk to your financial institution, maybe call GreenPath to do a financial assessment with us, and we can kind of take a look at what options might be appropriate. Another thing to help you prepare for an emergency is having a home maintenance fund. This is separate from your 3-month emergency fund. You should be setting aside money every month to have a fund of about 1 to 3% of your home purchase price every year. So having this fund is going to help make sure you can get your home maintenance done on time, so you don't have to incur a large expense down the line. So think about your furnace going out in the winter, or an air conditioner going out in the summer, or, oh my goodness, the roof starts leaking. You need to have money set aside to cover those expenses. If you own a home, at some point you will replace a furnace. At some point you may have to replace a roof. So having those funds set aside is a great way to plan. And one of the things I mentioned, we talked about the home inspection. This is where the home inspection can be an absolute gem, because that home inspector may be telling you in that plan, the roof is going to need replacing in the next 5 to 10 years. You can save for that. They may be able to point out it's a new furnace, it's a newer conditioner. So you're not going to need those replacements in the short term, but it'll be able to give you a thorough plan of what needs to be done. So you're going to want to follow that plan. Now, I will say there is a checklist offered by HUD that can help you as well. You can help you create that maintenance schedule for your home. And we're going to be providing a link to that in the chat. But you can also go to www.hud.gov and have a look for the home maintenance plan there as well. So again, look for that checklist. Being prepared is always better than, struggling with an emergency when it happens without a plan. Another way to cover cost of maintenance is through warranties. And again, people have different attitudes to warranties. My husband likes to self-insure. He doesn't like to buy those warranties when he buys an appliance. He wants to have money set aside so he can repair them. But he's an engineer. He can do lots of repairs, and that works for us. But you might want to consider, do you want to cover maintenance with warranties? The seller, when you're buying the home, the seller may actually offer you a home warranty. It may actually have appliance warranties included. Utility companies sometimes offer maintenance warranties as well for furnaces and things of that nature. You really just need to look at what is the cost of these and do they make sense. Again, often the seller may offer that home warranty to sweeten the deal. And maybe you can even ask your realtor to negotiate this as part of the home purchase if you know that your savings are going to be low when you first get into the home. After the year, you can decide if you want to continue to pay for that warranty yourself, or you just let it expire because you've saved enough money to kind of build that emergency fund for yourself. Something to consider again when it comes to warranties: as you purchase new items, do fill out the paperwork for the warranty information, because most give you 12 months, or if you purchase with a credit card, you get an extra length of time. So be sure to write down the manufacturer's information for those purchases, because that may come in use at some point. Obviously, you've got to remember that some manufacturer's warranties only cover defects. They're not going to cover wear and tear on items. So we've covered a lot of information. We've covered, getting your finances in order, looking at the budget, really working out what you truly can afford. We've talked about credit. We've talked about finding the realtor and financing the home and finally finding the home that's going to be right for you. One of the things you might want to consider, obviously, is, what other education might be helpful at this point. Again, this webinar is not meant to be everything to everybody for home buying. This is a great start. For more information, if you feel you want more assistance, again, you can take advantage of GreenPath through the MSUFCU partnership with GreenPath. We actually provide a free home buyers education counseling session. Normally that retails for $150, and that's free as part of this partnership. So take advantage of that. If you're concerned about credit, or maybe you want to get that spending plan in order, again, GreenPath can help you. Maybe you're watching this webinar and home buying is a dream for you at this moment. Maybe you recognize that, my debt load is too high. Maybe you want to have a conversation with GreenPath about the debt situation so we can help get you on that home buying path that much quicker. So again, GreenPath is a resource for you. Now, not only can you take advantage of our counseling through a conversation, we have a lot of educational resources as well. And one of those is an online education platform called the Learning Lab. And this is a link to the Home Buying 101. This is a series, 5 short courses. It talks about, are you prepared to buy, all the way to what happens at closing. 5 different, very short courses, but again, can help solidify and get you confident in your knowledge. To talk with GreenPath or to get more information on the website, because there's lots of educational resources there, This is our telephone number, 877-337-3399. And again, you can go to the website, greenpath.com/MSUFCU. I do want to emphasize GreenPath is a nationwide nonprofit that provides this financial education and tools because we want to help people lead financially healthy lives, and that includes you. So take advantage of our services. And I just do want to close out by saying thank you to MSUFCU for hosting this particular webinar, because this is great information. And again, I applaud you for attending. Good luck with your home ownership journey. I hope you find the most amazing home that brings you years and years of happiness. So Therese, if you want to stop the recording and then maybe we can go to Q&A, that would be awesome.
Sounds good. Yes, thank you again for that awesome presentation, Catherine. I mean, you really covered everything from when the thought first crosses your mind of when you want to purchase a home, all the way to the things that can, the unexpected things that can come up after you purchase that you may not have, thought or known about. Like you said in the beginning, you don't know what you don't know. So, so this has been really helpful. So once again, this recording from today's event will be posted to our YouTube channel within our seminar series playlist and should be available within about 2 weeks. For those of you not staying for the discussion, I invite you to take the survey that will automatically open after the event to allow us to consider your feedback. Additionally, don't forget to join us at some of our upcoming sessions. Our next webinar includes Raising Children with Financial Literacy on Thursday, February 22nd, and then Dealing with Difficult People on Tuesday, March 5th. And remember that attending qualifying live sessions automatically enters you into our monthly drawing to win a $50 Visa gift card. To learn more about that, you can visit our website at msufcu.org. So with that, I'll now stop recording and then we can address the questions in the Q&A. Thank you.